From Sam Bankman-Fried's 250 pages of unpublished X tweets being shared by the New York Times, to some potentially serious market competition for Binance, Gemini, and CoinBase, our eyes are on exchanges past and present. Some of the topics we're covering today could influence the markets in a pretty significant way. So let's dive into the good, the bad, the ugly, and the unknown outcome of crypto exchange news that we've seen this week. Let's start with the positive developments in the exchange space this week. First, Coinbase's CEO Brian Armstrong has revealed plans to integrate Bitcoin's Lightning Network, making it one of the largest platforms to do so. The Lightning Network is a layer 2 that enables faster and more cost-effective BTC transactions. This move seems to be in response to criticism from Jack Dorsey, the former Twitter CEO. In July, Jack tweeted at Brian saying, and I quote, "Why do you continue ignoring Bitcoin and Lightning? What crypto is a better money transition protocol and why?" Brian has denied the allegations, reaffirming his support for BTC and hinting at the company's exploration of the Bitcoin Lightning Network integration. With this announcement, his stance is crystal clear. Although the integration timeline remains undisclosed, it's a positive development for both Coinbase and Bitcoin. If you're interested in hearing more from Brian, we also have a recent video where he discusses the 10 crypto-related ideas that excite him the most. You can find the link to that in the description below. Next, for more good news, it's over to the Dubai-based crypto exchange ByBit. ByBit has announced a new and improved AI-powered trading platform just months after releasing its first iteration. Here's a recap for those that are unfamiliar. In June, the company released Tools GPT. This combines ByBit's market data with ChatGPT's AI tools to do a bunch of cool things, including analyze price trends of various cryptocurrencies like BTC and ETH, generate technical analysis, and answer user questions. As Vivian Fang, the head of financial products at ByBit, puts it, and I quote, "We built the tool that we all wish we had when we began our careers in financial engineering and trading." I personally haven't used the tool yet, but leveraging ChatGPT in trading has huge potential, and it's fascinating to see ByBit making use of it. Then in August, ByBit upgraded Tools GPT with a more functionality and wider dataset, and more human-like responses, and renamed it TradeGPT. One of the most notable updates, as per the company's announcement, is that TradeGPT can recommend optimal trading directions and timings for tokens. AI-powered trading is still a pretty new phenomenon, and it'll be interesting to see how it evolves and how useful it proves to be. And if you want to give it a try on ByBit, we have a fantastic deal on, believe it or not, our deals page, which I'll link to below. So with the good bits of exchange-related news covered, it's time to move on to the bad news. It's certainly been a tough week for Binance, the world's largest crypto exchange. For starters, Brian Schroeder, the CEO of the company's US arm, Binance US, resigned. He had been replaced in an interim capacity by the chief legal officer, Norman Reed. In addition to that, Binance US has reportedly laid off more than 100 people, which translates to roughly a third of its staff. The move comes 2 months after the parent company Binance Holdings reportedly laid off 1,000 employees. Layoffs suck, no matter which way you spin it. And spin it they have. Binance Holdings said of the first round of layoffs that the company, and I quote, "needs to focus on talent density across the organization to ensure we remain nimble and dynamic, ahead of," and I quote, "the next major bull cycle." A textbook piece of PR gibberish to really try and sugarcoat the fact that people are losing their jobs. As for Binance US, meanwhile, their spokesperson did a better job in my opinion. Rather than focus on layoffs, they sought to assure customers and the company that, more importantly, its users' funds were in good stead. The spokesperson said in a statement that, and I quote, "the actions we are taking to provide Binance US with more than 7 years of financial runway." That, I'm sure, is more like what customers want to hear. But in case you haven't forgotten, this isn't the only bad piece of news for Binance Holdings. Several other high-profile figures earlier this year have resigned, including its head of product, chief strategy officer, and general counsel. As well as that, the company is facing a legal battle with the US Securities and Exchange Commission, The SEC has accused Binance Holdings, its CEO Changpeng Zhao, and Binance US of misleading investors and regulators, mishandling customers' funds, and breaking security regulations. According to the SEC, the entities operated a quote, a web of deception. Yikes. Binance is contesting the charges, and a lengthy court battle could be on the horizon, not what any company wants to have to endure. It's now time to move on to the third category in this Bureau breakdown, the ugly. It's more bad news for FTX, and Sam Bankman-Fried is once again on the front cover of the New York Times. This time they've unearthed 15,000 words of unpublished tweets, which sounds more like an SBF manifesto. We'll get to that in just a moment. The latest developments in the FTX saga is that the US Bankruptcy Court has given the exchange approval to sell its crypto stash, which is revealed to be valued at $3.4 billion as of the end of August. The court filings also give a breakdown of FTX's known assets, including its crypto holdings. Notably, the company has a massive $1.1 billion worth of Solana, which is about 16% of the coin's outstanding supply, and around $500 million worth of BTC. While the judge ruling is good for FTX's creditors who are looking for their money back, the potential sale of a big chunk of crypto assets is putting downward pressure on prices. As basic economics dictates, when the supply of an asset is increased, the price of that asset tends to drop. Now, FTX's sales of the crypto assets will be capped at $100 million a week, though the limit could be raised to $200 million for individual tokens. And while to you and me, $100 million is a lot, in context, $100 million is actually a paltry figure. In fact, BTC's average daily trading this year has been around $7 billion. So whether or to what extent the sales of FTX's crypto assets impact crypto prices, that is the great unknown. Now on to SBF and his 250 pages of unsent draft posts. SBF candidly shares his unfiltered thoughts about who he believes is responsible for one of the most significant scandals of our time. In an unpublished X post, SBF shifts his blame to his ex-girlfriend Caroline Ellison, the former CEO of Alameda Research. In some warped world, he believes Ellison's refusal to hedge trading risks in Alameda played a key role in FTX's downfall. He wrote, and I quote, "If Alameda had hedged, it would have remained solvent and prevented the entire unfortunate story." This ranks completely off the scale on the BS detector. I don't know if someone needs to remind him that no amount of risk hedging can protect clients' funds from a selfish CEO who thinks he's above the law. In a document titled Truth, he concludes his point with, and I quote, "As a general rule, I don't lie." Wow. In the near future, Sam Bankman-Fried may become the most honest, libertarian, ex-crypto billionaire in Cell Block B. Anyway, I really recommend you reading the article if you haven't already. I'll provide a link to the resource and more in the description below. I'd also like to shout out Tiffany Fong for working with the New York Times on this piece. It was truly eye-opening. And now, in the last section, we move forwards into the great unknown, Huobi's rebrand to HTX. This has raised eyebrows in the cryptocurrency community. You can see why the rebrand has been viewed as slightly controversial. Looking beyond the name, could the rebrand usher in a new serious market player? Well, during Token 2049 in Singapore, Huobi, a crypto exchange marking its 10-year anniversary, announced their controversial rebrand. Led by Justin Sun, Tron's founder and Huobi's consultant, this move aims to expand the exchange globally and distance itself from its China-centric image. In case you were wondering, HTX stands for Huobi, Tron, and Exchange. Justin Sun, known for his lavish spending, like a $4.5 million dinner with Warren Buffett, made some significant moves, expressing interest in acquiring FTX's holdings to stabilize the cryptocurrency market. He made the announcement to his 3.4 million X followers. Sun posted, and I quote, "Contemplating an offer for FTX's holding tokens and assets to reduce their selling impact on the crypto community." Justin Sun appears to be eyeing not only the global crypto trading market, but also FTX's holdings. Sun's aggressive appetite for market acquisition does raise some questions about just how determined he is to see HTX rise to become a global competitor in the exchange space. While Zuckerberg and Musk might suggest a showdown in an MMA ring to battle for market dominance, crypto battles are fought on keyboards. It's a digital arena where the likes of CZ and Justin Sun would compete, so we're keeping our eyes peeled. So there you have it. Were you as shocked by Sam Bankman-Fried's unpublished tweets as I was? Are you curious to see what comes from the Coinbase Lightning Network integration? Are you bullish on Justin Sun's move forward with HTX? There is so much to discuss, so share your thoughts in the comments. And if you just can't get enough of CoinView, I don't blame you. For more quality content, you can check out our socials. And don't forget to sign up to our newsletter for more exclusive insights into the crypto market and where it might be headed next. See you next time.